to Hitting Home with Mike and Arif. And this week, we are thrilled to have President, CEO, and co-founder of New Haven Mortgage Corporation, Jason Vyner, with us. Jason, thanks for joining us.
Thank you, Arif. Thank you very much for having me.
Hello, Jason.
Hi, guys.
Jason, you know what? We've had on our show over the last several seasons, we've had a variety of guests, professionals of all walks of life, help our audience know and learn and understand about real estate and the transactions that they participate in. We've had lenders of different types on the show, but we are thrilled to have you because you come from an incredible diverse and growing and evolving segment of the market and financing, and that's commonly now known as the alternative lending space. And I'd really love to get your perspective and give our audience your perspective on really what is alternative lending, dispel some rumors, give some clarity, because it's not an often talked about, certainly not in the mainstream, not an often talked about market segment. So we're really thrilled to have you on and educate our viewers and get some perspective from you. So why don't you just give us a little bit of background?
Yes, perfect. I started in 1983 as a broker. My brother partner started First Place Financial in 81. We evolved into New Haven Mortgage Corporation, incorporated in 94 as a lender administrator in the alternative market. We employ 30 employees right now, which requires a lot of administration, underwriting, acumen to deals that come in from our broker space. So we have our focus and vision, Arif, is to get the borrowers to the banking side of things. So we're really, borrower retention is the name of the game today for us. So here we are 38 years later, and we pride ourselves on good broker borrower retention.
So your channel, your book of business, you are referred to by brokers predominantly or entirely from the broker space? I
would say probably 98% of our business comes from the brokers that are looking for alternative financing. Once they knock on a trust and or a bank door, refuse for one or many reasons, whether it be income and or credit.
All right. And what's the big difference really between you as a lender and, as you refer to, the big banks? What would you say is the number one difference for a borrower? Why are they coming to you?
Well, first of all, the banks are always and always will be lower rates and no fees when you go to a bank. For instance, a 5-year rate today may be 2%. Whereas New Haven Mortgage or the industry might offer anywhere between 5.99% and 7.99%. So there's a dramatic bridge between interest rates, which adds up. It's a considerable amount of money when you're talking 3-4% spreads. The problem that you have once upon a time in the banking industry, up to a few years ago, before stress test came into the banking field, was basically income and credit. You could have good income, but with bad credit, the banks deemed you as, unfortunately, you may make the money, but you don't pay your bills. The opposite way was that if you did have good credit, but didn't show the income, it was quite obvious that you could pay your bills, that you did make money. So there was a balance act with the banks at one time that they would take one over the other, unfortunately, unfortunately today, you need both to qualify for the bank. You must maintain good credit. You must have proper income by NOAs and or T1 generals or salary letters, whatever it took to prove your income and credit to the bank. So we play a very big role in allowing people in that space to become homeowners and debt consolidation and or business investments that they might not have a vehicle to obtain that financing in order to move forward in their lives.
Yeah, and the level of risk involved necessitates where that interest rate on that loan or mortgage lands. And typically with alternative lenders, that risk level is higher. It's beyond what the primary lenders are willing to engage in. I want to ask you right off the bat, can't steer away from pandemic. It comes up in almost any question on our show now in some regard. And the question would be, what are you seeing different in your business, perhaps in how you're working or the scenarios that you're seeing with regards to your clients? How has that changed or evolved over the course of the last year?
Well, it was over the course of 4 or 5 years that we really took a look at borrower retention and how to navigate with people that were in challenged times. Forget about origination when a deal came in, when the borrowers had problems. The first alternative way of working when somebody does go into arrears is basically a demand letter goes out. There's a letter that goes out to say, you're in arrears, please call us. And then all of a sudden, no call escalates to unfortunate legal department. And that's not where we want it to go. We found, especially with the pandemic, early March, deferrals were the big main topic with the banks. Hundreds of thousands of people were looking to the bank to say, listen, we may be in trouble here. And we adapt the same mentality. We adapted to work with the people. We found it was easier to work with them than against them. Let's hear the story, prove your story. And it's worked out tremendously. Unfortunately, the pandemic is tragedy to some extent in all from life and business and everything else. But we found that working with the people at the beginning of March, hearing their story, if Mr. Smith was making 50 and Mrs. Smith was making 50 and one lost their job or self-employed as a painter, and we knew that interior painting was not going to happen in the near future, we would look at their payment of $3,000 and cut it in half. If they weren't making the $50,000, we would come back to the people and say, no problem, pay us $1,500, we'll catch up later.
Okay. Would you say you have more leeway?
Jump in there, Mike, please, for a second. And that is that, Jason, we've got to go to break, and I really want to hold that thought, and I really want to come back to that thought. What you've just identified, though, is a massive difference between a corporation with your size of portfolio, which isn't small. It's a large portfolio, but certainly, you've added that human touch and that human element and human understanding compared to the institutions, where if you even claimed that you were accepting CERB, that might have been cause for disqualification from getting financing or refinancing. We got to go to break. When we come back, Mike, I'm going to let you start and ask that question, but stay with us. We've got Jason Vyner, President, CEO, and co-founder of New Haven Mortgage Corporation with us this week on Hitting Home with Mike and Arif. We'll be right back.
This program is brought to you by Ignite TV. Now you're in command. Visit Rogers.com for more details.
It was really fun working with them, especially when it comes to the studio tour, because it lets you meet the artists again and again. I hate to say nature inspires me, because every artist has it, but it is the grasses, the flowers, the trees, mostly rocks as well. So I use grasses over and over again. Every once in a while, somebody wants to have something special. They bring me their own flowers. For me, the glaze has to be perfect, and I like I said, a lot of depth in it. And that's it. All done.
Welcome back to Hitting Home with Mike and Arif, and we're joined by President, co-founder, and CEO of New Haven Mortgage Corporation, and we're talking about the difference between alternative lenders and really how you're operating the space versus the larger financial institutions. Mike, I had to cut you off. We're in the middle of an amazing conversation. Take it away, please.
Yeah, I just wanted to further to what you were talking about before the break. What I pick up from it and what's been my observation out there is the big banks, they have their lanes that they don't like to stray outside of. And if you need to be a little more flexible in your needs as a client, or if you need a lender who has a bit more flexibility, that's often where the alternative lenders come into play. And certainly flexibility has been a major requirement in light of the past year's events. And I would think the alternative lending community is probably more adept at being flexible and has probably been able to respond quicker and maybe to a greater degree than some of the other lenders. Would you agree with that? And maybe cite some examples of where that plays out?
Yeah, it's a good point, Mike. We help people that want to help themselves. Once they don't answer their doorbell or a letter or an email or a phone call, it's very difficult to apply the human touch, as you described. We feel that we designated our part of our administration staff into just that retention. Working with the people, but making sure prior to the conversation or at the beginning of the conversation to make sure that the borrower knows that whatever they're going to tell us, they must prove. There was a rush to the door at deferrals. Everybody thought they could do the system. For instance, somebody with a $3 million house and we have a $500,000 first with them, all of a sudden wanted the deferral, and they were not, shall I say, a hard case. In other words, they weren't desperate. They still put food on their table, and yet they just didn't want to pay their $3,000-4,000 a month. However, we classified that as a non-deferral. We did not allow the deferral because they had the availability of appreciation equity in their property that they could easily take a $20,000-30,000.
Yeah.
And we offered that. We offered a small increase in their first mortgage and prepay their mortgage payments so they could breathe. So whatever position that these borrowers were in, we allowed them, or we wanted to allow them to move forward and not to be in arrears. And funny enough, let's say 100 people walk through that door, 50 of them claimed one thing, and then you never saw them again. We reached out, we gave them an application to sign up, and we never saw them again. And yet we kept an eye on their performance, and they were still making their payments. So there was a little bit of navigation uncertainty of what our role was, and especially what the borrower's role was. To make that perfect fit.
So what I'm hearing though, Jason, is that it's not the Wild West out there. There still is due diligence being performed. You still want to make sure you have different prescribed, and just as a refresher for our audience, in the prime lending space, which is known as more the institutional, your big six banks type of space. Whether you're insured or not insured, there's also a different set of criteria. So if you're mortgage insured, the insurer may have certain stipulation requirements, as you said, through providing proof via notices of assessment, T4s, job letters, pay stubs, bank statements, et cetera. In your space, it is about proving the capacity or the ability to pay. You have a term that you like to use, and when we're looking at it, if we talk about credit versus income versus equity or security, you have an opinion that you're looking for. I need to know that my client has
skin in the game. Skin in the game,
right?
Very much so.
That's a fair understanding that they've got something to lose, that they're going to work hard. It's not free money. It's not easy money. You've acknowledged right off the bat that there is a gap or a separation between sort of your rates versus prime institutions' rates. But there is a transition, and your ideal client isn't sticking with you likely for 10, 20 years. All the banks talk about, it's easy to get in. It's the exit strategy. Maybe you can talk about exit strategy.
Yes, exit strategy. It's know your lender time. You mentioned Arif, which was perfectly put, the Wild West, and that's been close to 4 decades of what I've seen evolve, and it really hasn't changed. I think it's time. This program is indicative of what we need to do to educate the borrowers out there. It's time that the borrowers out there know their lenders, exit strategies, what happens at maturity, renewal fees, if any, where do rates go at that time? We've heard stories in the industry that the introductory rate might be 5.99 for a 6-month term, but thereafter, 6 months, they raise the rate to 7.99. They're not playing in the same rules and regulations as the bank. 2% 1 year, 5 years later, it might be 3, but they're offered 3 at that time, whatever the bank rate may be. So it's very important to know your lender. Move forward with an exit strategy, knowing, is it a credit problem today or an income problem that you were laid off for a while, you couldn't get back into a job. The banks look usually at 2 years. You can't be a doctor and change to a retail outlet or vice versa. They look like a 2-year history in order to qualify for your new income. So the alternative lending space is usually a 1-2 year lifespan. We like to help the client. It might be a debt consolidation problem, $100,000 second in regards to cleaning up their credit, cleaning up the R2s, 3s, which mean 2 or 3 months in arrears, or even a write-off, and consolidate the debt and repair their credit. They've got the income, they fell in hard times, their credit was bruised. The bank goes like this and does not look at them until repaired. And this is where the brokerage and lender world need to come together, hold hands with the borrower, and move them through to a 2% rate of interest, or alternatively, free and clear property and live happily ever after. So that's the name of the game.
So, Mike, when we come back from the break, what I want to talk about, and you shared with me offline before the show, a great question that you had about buy now versus buy later, and I hope we can transition into that. We got to go to break real quick, but when we come back, let's touch on that space. Let's touch on some of the trends that we're seeing here locally and slightly outside of our region in Simcoe County, Barrie and Simcoe County, where the borrower is looking to buy, and really where alternative lenders versus prime lenders fit into that space. Got to go to break. Stay with us on Rogers, and we'll be right back with Jason Vyner, President and CEO of New Haven Mortgage Corporation, on Hitting Home with Mike and Arif.
Join me in the next episode of Money Matters with Doug Jones, when I'll be speaking with Julie Kuzmic of Equifax Canada about your credit report, your credit score, and how it can affect you.
Hey, did you know? More than 4,500 Canadians are waiting for an organ transplant right now.
Right now. 4,500.
People are dying.
And you could save a life.
90% of Canadians say they're willing to donate their organs.
But only a few are registered.
So what are you waiting for?
Get registered.
It's easy and it's free.
Leave a legacy.
Be a hero.
Save a life.
Find out how to register today. Go to kidney.ca.
With NHL Center Ice, you get a premium ticket to the games you want every night of the season. Catch every key out-of-market matchup each week. You'll get more goals, more saves, more non-stop action from the teams you love. NHL Center Ice, part of the Rogers Super Sports Pack. All this for only $35.95 a month. Order through your remote on Channel 450 or call 1-888-ROGERS-1 today.
What kind of show do you want to see on Rogers TV? What interests you? Log on to rogerstv.com, fill out a show proposal, and tell us about your segment idea. We want to know what you want to see. Rogers TV, only on Rogers.
Welcome back to Hitting Home with Mike and Arif, and we're here and we're thrilled to have Jason Vyner, who's the president and CEO and co-founder of New Haven Mortgage Corporation down in Toronto. Mike, before we went to break, I was going to throw you this idea. You had a great question with me offline, and that was a buy now or buy later sort of analogy that you brought up. And why don't you take it away?
Well, buy now or buy later, but just to put a bow on that last segment, all of it seems to come down to education, and that's a big part of what you do. I see is educating that person. It's a big part of why people come through your doors, not having that education. I wish we did more in our schools, but that's a show in itself in preparing people for dealing with their finances. Part of that education would tie into at the start of the pandemic. Not that we were told specifically these things, but there were assumptions made that CERB was not going to impact upon people's credits, that delaying or stalling your mortgage payments was not going to have any credit impact in that. But I think our people are learning further on, either because they didn't do the homework themselves or the information wasn't readily available to them. People are, finding themselves in some challenging situations. But at the same time, overall, would you agree with me that we seem to have come through this, so far at least, in a far better position economically than many had anticipated?
Oh, absolutely. It was a nightmare thought process when the pandemic hit, and it reminded me of 1989 when we really didn't see 89 coming. We felt that, but it was 91 that it really raised its ugly head in the industry, and a recession, definitely a recession. It was close enough to a deep depression to a degree, especially in the real estate field, that properties went down 30-40%, and I was fearing for the worst and hoping for the best. And the hoping for the best kicked in. Who would have thought in a million years, when people are losing their job, that the real estate market took a sabbatical for a little bit of time, but with reduced interest rates that the bank was offering, it's mind-boggling how the real estate market has escalated into what it is now. 18-19% in value. Appreciation alone is incredible, and that's based due on a 2% mortgage. You take $1 million, 2%, $20,000 in interest a year, add on some principal, $2,200 a month. You can't even rent anything today, even though there's pressure on the rental market coming down a bit. But to be a homeowner and living in a $1.2 million home with a couple $100,000 down is amazing. The government and the banking system, I think, has really done a great job in helping sustain market values today for the homeowner of the borrower. That's the name of the game, is to be a homeowner. And so I've done a really good job.
But I would say, Jason, that's actually had a bit of a secondary impact, and that is also those who've realized why rent when I can own and when I can telecommute or work from home. It's also put a bit of that pressure and that X certainly on our region up here in Simcoe County and Barrie and surrounding area. And that has been leave the GTA, move to Barrie. And that has put a massive upward pressure on home ownership prices. Certainly, there are definitely, if I was to take a poll of who's buying the homes these days, it's less people who are rebuying within the area and more people who are migrating from the GTA into the Barrie and Simcoe County area. Correct. And that's definitely had an impact for this area up here.
When you have an average price in the GTA area of $950,000, give or take, it's a wonder how our children's children are ever going to afford a property. It's getting into the real estate market that's the problem. I just mentioned a 1.2 with $1 million mortgage. The problem is coming up with $200,000 today, saving $200,000 with prices of everything today. You need to make $250,000 just to near enough get by with a few people in your family and have a vacation or two and save up for whatever is valuable in your life. But it's going to be very, very difficult. The youth today are going to depend on the older generation, old money, as I call it, to hand it down. They might have to wait their turn. But this is exactly where people are moving. We've always been pro-rural route. And when I say rural route, outside the GTA area, it could be well in septic and or in town water, but anything north of the city, even east and west, all Ontario for New Haven mortgage purposes, that's where people have to go. And they don't mind a 30-minute, an hour commute to get to the office for if they're employed in Toronto. Always wondered how somebody could, an hour into Toronto, hour and back with the pandemic and our staff working from home for the last 9 months. I have somebody up in Ottawa that works for me, one of my underwriters after 16 years. I said, Deb, no need to ever come in the office again. You've got 1 hour into Toronto, 1 hour home, 1 hour lunch, and 1 hour chin wagging during the course of a day at the office. You've got 4 wasted hours, and now those hours are now being productive from a personal standpoint and or now from a business standpoint. I'm getting stretched hours from our employees. My point is this, that whether you work in Toronto and live in Sudbury or outside of the area, this is where people are understanding now, working from home, instead of paying $950, there's $500,000-$600,000 beautiful properties that if you do bring them down to Toronto, they automatically go up 300-400-500%. So the out-of-town properties from the GTA is really, really rampant, especially the cottage properties on second homes, Mike. You've got people now buying cottages realizing that travel is not in their vision anymore. Who's traveling? Who's getting on a plane today? And cottages are really, really taking hold of the economy, and people are purchasing cottages.
Yeah, and many of those second home cottages.
I'm sorry, Mike?
Yeah, I was going to say, and many of those second home cottages that are already in somebody's portfolio are being converted to primary residence. I'm seeing it. I'm helping people sell here to move to the cottage. And on a recent show, we talked about not just the work from home in and of itself being a major influencing factor, is technology, like satellite internet is going to be a major player in changing and shaping how and where we can live. And if you can be at your cottage, wherever that may be in Ontario, and get broadband internet that's going to allow you to do your Zoom conferences and do your work from home at a far more reliable rate, then why wouldn't you live there at year-round on the lake? That's where I want to wake up every morning.
I'm not sure if you guys knew that I invested in this new product called a laptop in March, and adapted Zoom into my everyday life. And it was a 6 a.m. to 6 p.m. at the office, running, getting dressed into a suit. This might be the first time I've had a suit on in many months.
And on that note, we got to go, gentlemen. We could do this for another half hour for sure. We're out. I'm sure the credits are already rolling. Jason Vyner, President, CEO, and co-founder, New Haven Mortgage Corporation, will be back with you. We'll definitely want you back on the show. Thanks.
We'll pick it up next time.
Everybody.
Be safe, everybody. Thank you very much.